Hello everyone, welcome back to the Chapple Show, and today we're talking about 10 mistakes that beginners make when they start investing in the stock market. So without further ado, let's get started. Number one, this is probably the biggest misconception that people have, is that they think it's quick and easy. Quick and easy money. That's the biggest misconception, one of the biggest mistakes. Usually for you to see a return, it's going to take weeks, months, or years. And it's not exactly easy either. You know, just because you have a really good feeling about this one stock doesn't mean it's going to go up and give you a good return. There's always some risk. So the stock market is just not a quick and easy way to make money. I mean, sure, you can invest in penny stocks, which can earn you quick money, but it is not easy whatsoever. It's really high risk. So that's why I'd never recommend going into penny stocks. So we're going to go to number two here, which is trading without a strategy. I see this mistake too often, you know, where people will just start trading just because they have a good feeling and they don't have a good macro strategy about how they should be investing. So my strategy, as I say in my stock market program, which you can check out, is, you know, I generally have this rule where you invest 80% in, you know, safe, long-term stocks, like blue chip stocks that everyone knows about that pay a good dividend. So you have not an automatic return, but you get a good return. And then I like to put, you know, 20% of my money into stocks that have a little bit more risk and a potentially higher return. So, you know, occasionally some tech stocks or something like that don't pay a dividend. But your strategy might be different. I mean, you might do a lot more value investing where you dig through a bunch of charts and financials and try to find companies that are undervalued. I mean, there's tons of different strategies that you can use, but the important thing is that you pick one and you stick to it. The number three tip is taking stock tips from big sources, or just taking stock tips. Actually not in general. I mean, mainly taking them from big sources where everyone is hearing the same stock tips. I mean, if everyone's hearing the same stock advice, odds are you're not going to have any sort of advantage. So what are some examples of this? Well, like you got the Jim Cramer, like Mad Money guy, like buy, sell, whatever. We're in a bull market, we're in a bear market. I'm buying right now, I'm selling right now. He gets really crazy, that Mad Money guy. There's a bunch of, you know, sources like on CNBC or BNN in Canada. And all those guys on TV saying like, I'm buying this right now, I'm selling this right now. I will just take in their opinion. I'll do some further research and see if maybe I should invest in a similar field to whatever they are investing in. Sometimes I'll do something like that. But for the most part, those people that are on TV screaming, buy and sell this stock, just don't really listen to them and don't buy the exact stock or sell the exact stock that they're talking about, because odds are it's not going to pan out for you because millions of people are hearing the same information. Anyways, we're going to move on here. Number four is short-term fluctuations. So anyone that started investing in the stock market without a lot of knowledge has probably been freaked out by what happens to their stock right after they buy it. A lot of the times, you know, if you buy a stock for $100 and you buy, I don't know, 10 of them, you invest $1,000, that stock will go down to about 99 bucks like right away within the first day, and you're going to start freaking like, oh my God, should I sell it? What should I do? Maybe should I buy more? Like, what do I do? And just hold your horses there. Stock values go up and down every single day. They can fluctuate by, you know, 5% sometimes. So after you buy a stock, it's reasonable that it can go down, you know, almost 5% within 24 hours of you buying it. What I will say is that 99.999% of the time, that is not a long-term trend, and just hold on, relax. You know what, after you buy a stock, if you're a long-term investor like me, or at least a medium-term investor that wants to hold on to a stock for a few months, don't even look at it for a few months. Don't even pay attention to it. Just buy the stock and just don't pay attention to any sort of short-term fluctuations. That's just going to cause you a lot of stress and it's going to freak you out. Number five is people become emotionally attached. You know, I get so many emails from young people especially that they get their eyes set on one stock specifically, and whether they've invested in it or not, they just get so attached to this one stock because they feel like they have so much riding on this one thing. And a lot of the times it's a tech stock. I mean, a lot of the times it's like a Facebook or it's a Snapchat. They will put in so much time and effort into researching these stocks and investing in them that they become emotionally attached, and they don't treat it like what it should be, which is just an investment. That's all it is. And from what I've seen is that when people become emotionally attached to their investments, that's when they make the most mistakes. So that's what I would like to say to a lot of beginners. Just treat your investments like investments and don't get emotionally attached. Okay, so we're going to move on to the number 6 mistake, and this is especially true if you're a beginner. And this is investing more than you should. So if you haven't even made your first trade yet, so I kind of have this rule where I always say invest a minimum of $500 at a time, because after you account for the brokerage fees and the stock fees, you have a better chance at getting a higher return if you invest a minimum of $500. But if it's your first time trading, you might want to just do a maximum of $500 too. Like, you just might want to do $500 just straight out as an investment. Because let's face it, if this is your first time trading and you've just been getting into stocks and you've just started learning about them, your first investment's probably not going to be your best one. Let's be honest here. So if you have $10,000 saved up and you want to start investing that $10,000, what I would do is invest $500 to start out. And don't touch anything for a week, and just monitor it for a week or 2 weeks or a month or something like that. And then after that, after you kind of get the hang of it, maybe next time you invest $1,000 in maybe the same stock or a different stock, and then you can go to $2,000 and then $4,000 or whatever your number may be. But I just recommend getting comfortable with what it's like to actually buy and sell a stock, or just buy a stock if you're doing the strategy of buy and buy more, like what I like to do. And yeah, just don't go all in on your first time. But we're going to move on to number 7 here, which is this one is a big mistake that a lot of people make, and this is selling for a loss. So this is one which is just, in my opinion, and what a lot of big investors do, and some big investors don't like to do this. I mean, I get a lot of hate from day traders and stuff that, I always say don't sell for a loss. That's kind of one of my part of my mantra, or mantra, however you pronounce that, of investing in the stock market, is that there are very, very, very few scenarios where I will actually take a loss after a trade. And I'll give you my one example. So my one example is, I've told this story before about how I invested in an oil stock in it was 2013. And I remember one day my friend came up to me and he mentioned the word fracking because he just heard it in some sort of environmental science class or something. And so I looked it up, and there was the Wikipedia page of what oil fracking is and how that's going to get passed potentially. This was before fracking was actually a thing. And then I was like, oh my goodness, the price of, and I invested in Canadian oil stock too. And so I got a little bit nervous, and I noticed that the stock price, the current price, was only about $1 less than what I bought it for, a few months ago. And so I decided to take a loss, because I thought there was a good possibility, which ended up being true, that the price of oil stocks would just plummet, especially Canadian oil stocks, would plummet after fracking became a thing, because the volume of oil would increase, so the price would go down. But I would say a case like that is more of an exception than part of the rule. I mean, I've had stocks that have dipped down to 5 or 10% below what I bought them for, and the reason why I say don't sell for a loss is because in the long term, there's a really good possibility that they're going to go way up again, especially if you buy a lot of blue chip or big company stocks. But for whatever reason, people panic about the short-term fluctuations. They just, like I said before, they will buy it for $100, and then it'll dip to $95 or $96 in a week or a day or something like that. And then they start to get worried, oh my God, is it going to go to 60? Is it going to go to 50? Is this company going bankrupt? And most of the time, it's just a short-term thing, and the stock will rebound. So selling for a loss is something that I don't recommend under the vast majority of circumstances. Just hold on to it and it'll bounce back up most of the time. Although I will say that there's always some exceptions, especially in tech stocks. I know I've been drilling that into you guys. Tech stocks, like one of my mentors especially, he bought a BlackBerry stock in 2007, 2008, 2009, somewhere around there when BlackBerry was doing pretty well. And then we all know what happened to the BlackBerry stock. It went down 90%, and he still has that stock. He is still holding on to it like, oh, come on, BlackBerry, come on. He's not willing to take that loss. And it's a good point, like what would he would recover, what, a few $1,000s? It's not really worth it. It's better hanging on to it and not taking that, whatever, that $10,000 loss or whatever that may be. The number 8 mistake that I see, oh, there we go, number 8, is fees. For whatever reason, just people don't look at these. You can go onto Wikipedia, like I talk about this in my program. A lot of people, they will pick a stock brokerage and they don't even bother looking at the fees. They will pick a mutual fund, don't bother looking at the fees. They'll pick an ETF and not bother looking at the fees. And this is really important. So a lot of the times when you invest in this is mutual funds, and ETFs are better, usually better. But mutual funds or ETFs, they will have a 1% active management fee, meaning that if you were to invest $100 in the company, they will take 1% of that, regardless of what happens to the stock or to the fund. They will take 1% of that out to pay themselves every single year. Now, 1% is, in the long term, that's a ton of money. I mean, if you were to invest properly from the age of 20 to the age of 60, we're talking that could decrease your investment portfolio by hundreds of thousands of dollars potentially, depending on how much money you make and how much you invest. So it's important that when you start investing in stocks when you're a beginner, pick a brokerage that has small trading fees that are like $5 now. When I started trading, actually, the fees ranged from $30 or $25 to $50, and now they're $5, and that was only 5 or 6 years ago. When fees were $25 to $50 a trade. So it's actually amazing how far these fees have come down. It's good to just pay attention to your brokerage fees, but also the management fees of the funds or the ETFs that you're investing in. I think Vanguard's really good at having low management fees. I think that they're at 0.1% or something like that, which that's pretty much negligible, right? So when you go to look at a stock, just make sure you look through all the fees that come along with that stock, especially if it's some sort of, like index, ETF, mutual fund, something like that. Because if you see a fee that's 1% or above, I just wouldn't even look at it. I mean, I just don't even look at any that are above 0.5 most of the time. So that's something to think about for you guys. The number 9 mistake that I see often is reinvestment, or I should say lack of reinvestment. So what happens a lot of the times when you start to make money in the stock market, whether you're going the route of buying low and then selling high, or whether you're doing my thing, which is just betting on dividends and just taking a 4% to 6% dividend every single year, what a lot of people do is they will take that money, they will take the profits from that. So if you were to buy a stock we'll do a buy and sell one. You were to buy a stock for $50 and then whatever reason, it goes up a giant amount one year, which never happens. It goes up to $100, you make a $50 profit. What a lot of people will do is they'll take that $50, the profit, and they will just go buy a video game or a purse or something like that. Meanwhile, how you really get wealthy from the stock market in the long term is by reinvesting that stuff. If you reinvest the profits, the dividends, the capital gains, you reinvest all of that money, you're going to end up, if you invest like a normal investor, making hundreds of thousands of dollars more than someone who just invests and then takes their money out. So what I like to say is that anyone investing in the stock market, just make sure, this is probably one of the most important things here, is just reinvest your earnings. That's the most important thing you can take from this. But we're going to move on to number 10 here. Number 10. And this is trading too often. Let me explain here. So I've mentioned this before. So do you know how many times the average millionaire that has a large investment in the stock market, do you know how many times on average per year that they make an investment or make a trade? Take a guess. Once. The average millionaire investor in the stock market makes one trade, every single year. And do you know what kind of trade that is? It is always a buy. So they're always buying stocks, and they very, very, very rarely sell stocks. You know, when beginners start investing in the stock market, like we're going to go back to number one here, they want to get in, they're like, this is a good way to make some quick and easy money. Meanwhile, most people who actually get the good returns in the stock market are the ones that don't really trade too often. I mean, I tell the story of the janitor. I heard this story about 2 years ago. He actually died, and what happened was he was a janitor making, I think by the time he died, he was making $40,000 or $50,000 a year. He was still being a janitor at like 80-something years old, and he started investing in the stock market when he was 18. And his strategy was buy and buy more. So he never sold a single stock, and he retired with $7.6 million or something around there. I think it was about $7.6 million. And this was a guy who was just making an average income, but he invested properly, he reinvested, and he only really made 1 or 2 trades every single year, and it was always a buy, and it was generally in S&P 500 companies. And I'm not saying that all beginners have to take that same investment route. I mean, if you really want to trade every 3 months, or you want to go the buy and sell route, go ahead. But odds are you're going to make a better return if you go for the long-term investing and take the buy and buy more strategy. I mean, investing in the stock market, people think that that's going to be their job. When a lot of beginners start investing, they're like, I have $5,000 and I'm going to make that into 10, then I'm going to turn that into 20, I'm going to turn that into 50, and then 100, and that's going to be my job, and I'm going to make lots of money just doing that for my career. Meanwhile, stock market investing should be for people who want to make a little bit extra money on top of their income. So if you're making $50,000 a year, you maybe invest, I don't know, what's a good number, $5,000 to $10,000 in stocks, and then maybe every single year you'll make an extra, $1,000 on top of that, and then that adds up. If you keep investing parts of your income, you'll keep earning a good return, and in the long run, you're going to have a giant stock portfolio if you do that for decades. So I think that's going to kind of wrap it up here. I'd like to ask you guys, what mistakes have you seen, especially from beginners in the stock market, or maybe when you invested, what kind of mistakes did you make? I mean, leave a comment down below. I think that's going to wrap it up. So I'd like to thank you very much for watching. You're all very beautiful people. I'll see you guys in the next video.